But we first, as a panel, thought it would be best to get a picture of the current lending landscape. So let me go there. Where rates are, who's lending, kind of what the liquidity is in the space today. So I'll put this slide up, and I'll ask each of you to explain just some of the general rate and lending trends that you've been seeing, how the agencies, banks, alternative lenders are doing, and maybe a few forward-looking thoughts on the debt and M&A markets. So Nick, I'll throw that to you first, kind of just set the scene for us.
Yeah, perfect. Thanks a lot, Ben. And excited to be here to help walk through some of these topics. We're in a really interesting, and by interesting I mean challenging, interest rate environment where there's a bunch of positives and some negatives. I think two things that are worth pointing out is SOFR and the Treasury have gone in opposite directions since the rate cut in September. We've seen SOFR drop from just over 5.3% down to just over 4.8%, which is a benefit for the billions of dollars of variable rate debt that we're seeing in this sector. So anyone that has that debt is starting to finally see some relief in their month-to-month interest costs. At the same time, when the Fed cut rates, the 10-year Treasury was about 3.73%. And actually today, 2 days after this slide was put together, the 10 years up to, where is it right now? 424. So we've even picked up 7 basis points on top of this rate. So we've seen, over 0.5% increase in the 10-year. The 10-year is an important indice because it dictates, or at least is highly correlated to where your FHA, your Fannie, your Freddie interest rates are priced. And so the movement in the 10-year Treasury by going up that high really correlates to an increase in HUD rates, an increase in Fannie rates, increase in Freddie rates, while the decrease in SOFR is obviously bringing a lot of relief on the floating rate bank debt, which is mostly priced at SOFR, some price at prime. But that saw a decrease as well. So I think we're in this interesting period where we are seeing some relief. We do see the market price in further rate increases on the Fed, which will improve SOFR. At the same time, I think the economy is feeling like a recession is less likely given some of the Fed moves. And that's creating greater optimism, which leads to a higher 10-year Treasury rate. So that coupled with, I guess, projections of inflation. So we're at a little bit of a dichotomy where over the last month or two, borrowing has become more expensive, although carrying variable rate cost has gotten less expensive. And I think that's an important dynamic for a lot of both, buyers or refinancers, as well as holders of existing indebtedness. I think the rates we see here are pretty indicative of where deals would price. The range, I guess, was high enough where we see HUD rates in the mid fives before the mortgage insurance premium, so about 6% all-in cost. The Fannie and the Freddie rates are in the low 5 to mid 5% range. And an important distinction there is FHA rates are all long dated fixed rates. So these are 25 to 35 year amortizing loans. Fannie and Freddie have the ability to price off of the yield curve. So you can price a 5-year, a 7-year, a 10-year, 12-year, even longer. So the duration or the term you want to pick on those will dictate the pricing. But these rates here will give an indication of kind of where that fixed cost borrowing is. So just some quick thoughts on where we are from a rate perspective today.
Yeah,
Ben,
Matthew and Zach, go on.
Oh, sorry.
Go on, Matthew.
No, I was just going to say, I think I'm 100% agreement with Nick's comments. I would suggest one of the things which is really kind of perplexing in today's interest rate environment and debt origination environment is a couple of years ago when SOFR was much higher, there were existing borrowers looking to move to fixed rate debt as quickly as they could because of the associated decrease in debt service payments. But as the 10-year has grown in terms of yield, the long 10-year interest rate environment for long-term fixed rate debt becomes less appealing. And that has two different effects. Number one, your debt service payment is higher just because your coupon rate is higher. And that may actually adversely impact the amount of proceeds that you're able to get upon refinancing. So there's pressure there. But as important, locking into a fixed rate debt at what's comparatively a higher fixed rate debt makes the assumption of that debt, if you're contemplating a disposition in the future, less attractive. So there's a bunch of things that have to go on as an existing borrower today with a maturing floating rate debt, what their options are, what the associated cause and effect is to originating a new loan, whether it's a fixed rate or a floating rate debt. So it's a pretty interesting interest rate environment, as Nick said. And I would also add that, one of the things I agree that the thought of a recession has diminished and the confidence in the economy is building, suggesting that the yield is going to go higher on the 10-year as opposed to going down. One of the things that historically has been a limiter to the rise in yield is international conflict. And I feel like I've been saying this for 10 years now. We've seen nothing but international conflict for the last 10 years. And we've seen in the most recent past in the Middle East, we've seen one of the most volatile geographic situations in recent memory. And thoughts like land invasion are conversational at this point. And yet they have not had an adverse impact on the 10-year yield. And I think it's remarkable that has occurred. And the only thing I can suggest, and this is purely opinion, is that the world has measured the cause and effect of the current conflict in the Middle East and has concluded that it's not going to go past the borders of the Middle East. Because if it did, I think you would see more of a rush to quality, and that quality being the guaranteed 10-year UST.
Mm-hmm. Yeah, that's really interesting. I can't say that I can add a lot of value in terms of global, macroeconomics and war theory. But to the extent that the 10-year and the extent that 10 years risen today, and the fixed sort of rate permanent financing has gone up. There's also the inverse of that, which is we're seeing deals where people are able to assume sort of existing HUD debt that was originated back when interest rates were near zero, and those today are incredibly attractive financing vehicles that allow for groups like ourselves, for example, to add holdco mezzanine financing. Rounding out the capital stack, it provides a lot of optionality. But then, taking a step back just in terms of, the overall markets outside of kind of the permanent financing, we're mostly playing in, the bridge sort of transitional assets, the value add assets. And at least from our perspective, the top of the market, the 50 million plus, the large portfolios, the stabilized assets, the cash flowing assets with institutional sponsors, those tend to be pretty attractive to a variety of buyers. And so we're finding that cap rates are compressing a little bit. People are really people are really getting aggressive there. And the other piece of that as it relates to the debt market is the debt funds that have raised a lot of capital that historically have played in multifamily, industrial, and even office are looking to the seniors housing space and seeing it as an attractive sort of yield relative to what they can get in the industrial and the multifamily market. And so again, we're seeing sort of cap rates compress and the sort of lending market become sort of extremely competitive. Again, this is at the higher end of the market, more stabilized institutional assets. For us at the sort of lower middle market or middle market, I think there's still some pockets of inefficiency, and I think we'll touch upon some of these fact patterns. But to the extent that there are assets out there for sale that are where the sale is being driven by the lender, I think that there's opportunities to pick up those assets at a discount to what it costs to build them. There's maybe a turnaround. I think that we're seeing some inefficiencies in the construction market. There's not a lot of bank financing for construction. A lot of LPs are having trouble raising capital, and I think there's a little bit of gap financing that needs to be sort of slotted in there to fill out some of those capital stacks. So on the one hand, I think that there's some sort of bidding up of assets and some compression of spreads. But on the other hand, I think there's still some inefficiencies. So
yeah. And then quickly on the liquidity side, can you guys just comment on what the banking environment is like? And also a lot of the chatter at Nick was that Fannie was coming back in a bigger way. So would you like to comment on that? And then also on the kind of the difference in interest rates that multifamily borrowers can get versus seniors housing borrowers from Fannie and Freddie.
And I would put one more question on that, Ben, and I think most of the audience probably knows this answer, but Nick and Zach, if you'd speak a little, we've talked about the changes in the indice with the SOFR falling and the 10-year rising. I think it'd be really helpful if you guys could provide some color on what's happening with indicative spreads. So specifically, Fannie and Freddie are the easiest ones to probably take advantage of. I can talk a little bit about sort of debt fund spreads and what they're doing, but I think that's obviously a necessary component of the coupon buildup. And it'd be great to hear your comments on the volatility of those spreads.
Yeah, it's a good segue. I'll take that. I think that what the point, Matthew, that you made a little bit earlier around the complication of looking at fixed with where the 10-year treasury is going versus floating is really important. I think now more than ever, how you capitalize a transaction is a statement as to your view of the interest rate markets, right? Locking in fixed rate financing today may be great, or it could be detrimental if rates drop, 200 basis points because of a recession, because of global conflict, because of, a flight to quality. And so the calculus there, I think, is the old adage of if it works, lock it in, right? I think still prevails in a lot of cases, but I think it does require a lot of time and attention to think about the strategy of, pricing shorter on the curve, longer on the curve, variable rate with caps or swaps versus fixed rate. And what we're seeing with the market right here, just with looking at the 10 years and the SOFR rate, is kind of really, making those conversations much more important if you're an existing borrower or future borrower. I think that to Ben and Matthew's question around where the agencies are, I think Freddie has come back, I think, a little more aggressive than where Fannie Mae has from an agency perspective in the seniors space. Not to say that anyone is being aggressive in this market. Everyone is conservative. Loan to values for the agencies are 65%, maybe up to 70 for repeat sponsors with really strong liquidity and experience in a market. They're being pretty cautious around new assets. So older than 10, 15 years, that vintage, they're going to want to see a lot of CapEx that's already been reinvested in them, or is being reinvested in them. So I think they're kind of playing it safe as it relates to high sponsor, high liquidity, strong operational or management experience in quality assets. Occupancies, where there would be some conversation around, hey, it's just below 85 or below 90. Low occupancies, kind of a non-starter with the agencies right now. So I think generally speaking, I think it's conservative, but they are expressing a lot of interest to look at deals. And I think over the coming quarter or two, we'll start to get a feel for just what appetite they have from a volume, amount of capital they want to deploy in this sector. So I think that's going to be a little bit of an iterative process. From a spread perspective, spreads have widened, so that's part of the conservatism here. It's also part of the overall interest rate volatility that we're seeing in the markets. And that's kind of where we're coming with some of these indicative pricing. And again, I would say we, probably, put plus 10%, or I'm sorry, 10%, 10 basis points on this, on the high side of what we're seeing here for Fannie and Freddie, as kind of a good indication today. I think, Ben, you had asked the question around multifamily versus seniors. And so I think that a multifamily deal is going to price at a tighter spread to whatever indice it is priced off of. So a 5-year multifamily Fannie or Freddie deal will price lower than a 7-year, or I'm sorry, than a 5-year seniors housing deal. So seniors housing is going to have a wider or larger spread. So same loan structure, a Fannie Mae seniors deal will have a higher interest rate than a corresponding multifamily deal. And part of that is just the overall risk profile. Multifamily is less operational intense. And I think that the market, seeing what's happened post-COVID, has put even more of a premium on the operational component to it, which is part of why, spreads, i.e. the gross interest rate has increased with the seniors housing product.
All right, great.
Zach, I don't know if you want to touch on banks or Matthew. I don't want to steal the
Or just
conversation too
liquidity
much.
in general, kind of looking forward.
So looking at things from a debt fund perspective, because Berkshire does have a multifamily and seniors housing debt fund, there is a significant amount of interest in putting out bridge debt in seniors housing. The advantages of going with a debt fund, whether it's Berkshire or anybody else, is that generally speaking, the debt funds are less conservative with respect to loan amounts. So the primary business that Berkshire has closed on the bridge fund side of things is related to maturing debt that that a sponsor has, and they're coming to us saying, given current valuations or given current cash flow, we can't size this to a long-term fixed rate agency deal. So we need to bridge to a better time where we can improve occupancy and operations and hopefully get a higher valuation so that we're able to pay back our entire indebtedness in the current mortgage structure without having to be a cash in refinancing. So that's been critically, kind of the number one sponsor profile of coming to us from the debt fund. Now, with larger proceeds comes a larger spread. So our spreads are certainly wider than Fannie and Freddie. And I think from a long-term fixed rate perspective, the agencies probably, including HUD, certainly have the pricing advantage. Short-term bridge debt, I would suggest relationship banks, regionals, locals, and super regionals probably have the next best cost of funds. And then private equity debt funds have the third best pricing from a spread perspective. They're pricing off of SOFR. But the things to keep in mind about a debt fund and why someone might choose a higher rate, they either can't get bridge financing from a bank because of balance sheet capacity of the bank or whatever, or proceeds aren't enough to repay current indebtedness. So there's really three options. I'll defer to Zach on kind of bank spreads, but I would suggest that the debt funds are out there. They generally can offer more proceeds on a refinance, but they charge you for them in terms of spread.
Yeah, candidly, I don't have a sort of off the cuff answer as to where sort of bank spreads are today. From just bifurcating the market, like as it relates to skilled, it feels like the cash flow in the skilled space has been really attractive to banks, particularly in the past 4 to 5 weeks, and we found that banks have really sort of come back in a meaningful way into that space and are really sort of bidding on assets pretty aggressively. And then in terms of the senior space, it feels like the banks aren't necessarily fully back, but there is, from our perspective, some ability to participate with banks to sort of structure deals where there's a senior bank lender, and maybe we're the mezzanine piece. And then outside of that, before kind of the most recent interest rate cuts and just sort of the sort of general feeling that maybe inflation is behind and maybe the worst is behind us. We were doing a lot of deals where, the banks, candidly speaking, just weren't there at all. And our spreads were, pretty, similar to bank, not that much more expensive. But we weren't levering our position. We weren't partnering with a bank. I think that, those types of transactions, while there's still maybe a few more of them, it feels like, maybe that sort of part of the market has gone away. And I'll give you an example. So a colleague of mine recently closed a deal with an owner operator that looked to acquire an asset and needed someone to come with majority of the capital stack. And so we provided that financing option, allowed this particular sponsor to acquire the asset, fund a little bit of the operating reserves, and from our perspective, it's a great deal because it's a good basis. It's an owner operator that we really like and respect. We've done a lot of business with. I think this is the fourth deal that we closed. But from the owner operator's perspective, they get a financing partner that's going to maybe participate a little bit in the upside, but at the end of the day, a majority of that upside goes to that entrepreneurial operator who's looking to acquire an asset and is really sort of putting the work in. So but outside of that, if you were to sort of take a deal in which we would partner with a bank, there's maybe a few where the asset is newly built and a bank is maybe looking to sort of shed the asset and is forcing the sale. And again, we're kind of coming in, but they're just given kind of where the capital markets are, the banks maybe have come back a little bit. We're providing a mezz piece, and the operators is providing the remainder of the equity. So I think the banks are coming back, but I don't have a good feel for exactly where they're spread.